What if I told you that while you were watching this video, money was being moved, right now, in ways that would make your head spin? Half a world away, a conflict most people think of as politics is actually a psychological operation targeting your wallet. And here's the scary part. Most people watching this have already lost money because of it. They just don't realize it yet. When Iran and Israel escalate, when the US postures, when threats fly across the Persian Gulf, retail investors panic. They sell, they buy gold, they move to cash. And every single time, they get played by the same psychological trap that's been draining wealth for 50 years. The smart money, they're doing something completely different. And in exactly 90 seconds, I'm going to show you a chart that hedge funds have been trying to keep retail investors from seeing. It explains why you're probably positioning your portfolio exactly backwards right now. But first, you need to understand what's actually happening, because this isn't about politics. It's not about who's right or wrong. It's about how human psychology gets weaponized during geopolitical conflict to separate you from your money. Let me give you the thriller briefing, the actual chronology of how we got here, told through the lens of money, not missiles. November 2022, the United States imposes new sanctions on Iran's oil exports. The real, Iran's currency, had already lost 85% of its value since 2018. But these sanctions hit different. They targeted Iran's ability to sell oil to China, its last major lifeline. March 2023. Iran begins enriching uranium to 60% purity, just a technical step away from weapons grade. The IAEA confirms this. Oil prices jump 8% in 3 weeks. Why? Because the market starts pricing in something called a geopolitical risk premium, the extra cost of uncertainty. October 7th, 2023, Hamas attacks Israel. Israel responds. Within 48 hours, Iran-backed groups in Lebanon, Syria, and Yemen join in. The S&P 500 drops 2.5% in 1 week. Gold jumps $50 per ounce. And here's what nobody noticed. The dollar index surged. Why? Because when the Middle East heats up, global money runs to one place. Not gold, not crypto, the US dollar. January 2024, the United States strikes Iran-backed targets in Iraq and Syria. Iran responds with missile attacks on US bases in Erbil. Markets shrug it off. Barely a blip. Why? Because the pattern was already established. Traders had learned to parse rhetoric from reality. But then came April 2024. Operation True Promise. Iran launches over 300 drones and missiles at Israel. The first direct attack from Iranian soil. 99% intercepted, 0 casualties in Israel. But here's the financial psychological twist that changed everything. Oil prices spike 4% in hours, then collapse just as fast. The VIX, Wall Street's fear gauge, jumps 30%, then normalizes within days. And this brings us to that chart I promised you. This chart shows every major Middle East conflict since 1973. Look at the pattern. Every single time retail investors panic at the wrong moment. They buy when smart money is selling. They sell when smart money is buying. They're playing a different game, and you're about to learn what it is. Now we're getting to the psychology that's actually moving markets. When you hear the words Iran, Israel, conflict, your brain doesn't process it as information. It processes it as threat. The amygdala activates fight or flight. And in financial terms, fight means panic buying. Flight means panic selling. Both are wrong. Here's how this plays out in the real world. A headline breaks. Tensions rising in the Persian Gulf. Within hours, gas stations raise prices, not because supply changed, but because they can, because they know you'll pay. This is called anticipatory pricing, and it's pure psychology. The actual oil supply doesn't change for weeks or months, but the fear of supply disruption moves prices instantly. During the 2019 Saudi Aramco attack, when drones took out half of Saudi Arabia's oil production, oil spiked 20% overnight. But within 2 weeks, it was back down. Because the disruption was temporary, the panic was permanent, at least in people's memories. This is herd behavior in action. When markets drop during geopolitical tension, something called an information cascade happens. One person sells. Their neighbor sees it and sells too. Suddenly, everyone is selling. Not because they know something, but because everyone else is selling. During the Gulf War in 1990, the S&P 500 dropped 20% in 3 months. By the time the war actually started in January 1991, the market had already bottomed, and it was recovering. The people who sold at the bottom locked in losses. The people who bought made 30% in 6 months. This is the geopolitical risk premium, and it's one of the most misunderstood ideas in finance. Wall Street pays you to take risk. The more uncertain the world becomes, the higher the expected return. But here's the catch. Most people confuse risk with volatility. Volatility is price swings. Risk is the chance you never get your money back. Geopolitical conflict creates volatility, but unless it's an existential threat to the financial system, it rarely creates permanent loss. Yet retail investors treat volatility like risk. They sell at the bottom, they buy at the top, and they lock in losses that smart money captures. And there's one specific trade that gets missed during every conflict. A safe haven play that 97% of retail investors ignore, even though it's what central banks actually do. I'll show you what it is at the 7-minute mark. But first, there's a hidden mechanism operating beneath all of this, one almost no one talks about. Here's what mainstream media never explains. The Iran-Israel conflict is partly a currency war. The petrodollar system, created in the 1970s, means global oil is traded in US dollars. This creates artificial demand for the dollar, and it gives the United States a powerful advantage. It can sanction countries by cutting them off from the dollar system. When the US sanctioned Iran in 2018, it didn't just restrict trade. It cut Iran off from global finance. Iranian banks couldn't transact in dollars. Businesses couldn't accept international payments. The real collapsed. This is sanctions psychology. When you destroy a country's ability to trade, you create hyperinflation that destroys ordinary people's savings. Food prices double. Life savings evaporate. And here's the twist. This doesn't just hurt Iran. It creates incentives for other countries to find alternatives to the dollar system. China and Russia are building alternative payment networks. Iran is accepting yuan for oil. Slowly, quietly, the petrodollar system is being challenged. Why does this matter to you? Because if the dollar ever loses its status as the world's reserve currency, everything changes. Interest rates, inflation, your purchasing power. Now let's talk about Israel, because Israel has a fascinating economic dynamic. During every escalation, Israel's defense stocks surge, but its tech economy keeps growing, even during conflict. Why? Because Israel has built something like a war economy psychology, innovation under pressure. The same military tech crossover that created Iron Dome has produced one of the world's most vibrant startup ecosystems. Retail investors see conflict and sell. Smart money sees innovation under pressure and buys. Which brings us to safe haven assets, where retail investors make the same mistake every single time. When tensions spike, people pile into gold. Gold jumps, then pulls back just as quickly. During the April 2024 escalation, gold hit a record $2,435 per ounce. Within 2 weeks, it was back below $2,300. Gold is a fear trade. It spikes on panic, then normalizes when the world doesn't end. Unless you have perfect timing, you're probably buying the top. So what do smart investors do? They don't trade the panic. They position for the aftermath. And this is the 97% trade. During every geopolitical crisis, retail investors pile into gold, but institutional investors buy U.S. treasuries. Why? Because when the world gets scary, global money flows to the safest asset on Earth, U.S. government debt. The yield may not look exciting, but when everyone rushes to safety, treasury prices rise. Retail investors buy the headline trade, gold. Smart money buys the institutional trade, treasuries. This is why central banks hold treasuries as their primary reserves, because in a real crisis, liquidity matters more than shiny metal. So what happens next? As of March 2026, there are 3 realistic scenarios. Scenario 1, contained escalation. Intermittent strikes continue. Markets normalize. Scenario 2, oil shock. Major supply disruption. Oil spikes to $120 to $150. Inflation accelerates globally. Scenario 3, regional war. Direct Iran-Israel confrontation. A massive risk-off event. Safe havens surge. But here's what most people get wrong. They try to predict which scenario happens. Smart money doesn't predict. They position for multiple outcomes. Energy stocks as an inflation hedge. Treasuries as a deflation hedge. Quality tech stocks for growth. Defense contractors for the conflict play. Hedge funds build portfolios that work across all 3 scenarios because fear creates opportunity. Retail investors overreact. Markets price in worst-case scenarios that rarely happen. History rhymes, and smart money knows the verse. The psychological trap? Thinking this time is different. The reality? The same drivers always appear. Fear, greed, herd behavior, loss aversion, and smart money captures the mispricing. Let me close the loop on that chart. Every time there's geopolitical conflict, retail investors panic at the wrong moment. They buy when smart money is selling. They sell when smart money is buying. The pattern has repeated for 50 years, and it will repeat again. But now you know the difference. You know oil spikes are psychological. You know safe havens aren't always what you think. You know smart money doesn't predict, it positions. Here's the one sentence that should change how you see geopolitics and money forever. Geopolitics creates volatility. Psychology creates opportunity. The conflict isn't the problem. Your reaction to it is. Thanks for watching. And remember, don't just watch the news. Watch what smart money is doing while everyone else is watching the news. If this video changed how you see geopolitics and money, hit subscribe and drop a comment below. Do you think oil hits $120 in 2026? Type oil if yes or stable if no. Let's see who gets it right.